Good morning, good afternoon, good evening to everyone joining for this webinar. What we're going to do today is discuss some recent approaches that governments are using to close financing gaps in public-private partnership projects. In particular, we're going to look at a few different mechanisms that have been developed recently that have a little bit of a track record. And we are also going to look at some of the implications of these. We'll look at what we know about the performance to date, what lessons can be drawn for other countries, and more broadly, what is it that we can learn in terms of leveraging private sector investment in infrastructure going forward. So let me start to take you through the presentation. And first of all, I just want to give you some background numbers on what's going on with private infrastructure. First of all, let me just explain a little bit about what the graph on the right is showing. Some of you may be familiar with this data source, but others probably aren't. This is from the World Bank PPIF Private Participation in Infrastructure database. It covers emerging markets. It covers projects with private participation, different types of projects, so it doesn't completely map to what you may think public-private partnerships are, but it's really the only global data source we have. And it records information both on new projects and investment on existing projects. What I'm showing you here is the information on investment in new projects, investment commitments that's how the database records it, by sector, and it's by the first 6 months of each year. And I'm doing that because for 2011 we only have the first 6 months. So one thing you can take away from this is, at least in emerging markets, investment has been pretty robust following both the onset of the global financial crisis as well as some more recent tightening, although we won't have seen all of the impacts of that yet. So at least at the headline level, it looks good. In fact, we saw that in the first 6 months of 2011, investment levels were almost close to the highest they've ever been, 43 billion. But as you can see, as some of the notes on the slide show, this is extremely concentrated in a few countries. So actually, if we took out India and Brazil, investment would have fallen by over a third. And perhaps more worryingly, if we look at the number of projects, actually the number of new private participation in infrastructure projects, it's actually the lowest number since the early 1990s, at only 20 countries that actually did these. So we see an increasingly concentrated and narrow sort of range in PPPs. At the same time, as we're all aware, as governments are trying to bring in the private sector because their own fiscal resources are constrained. A couple of other things that are going on in many markets is we're seeing that commercial bank debt is increasingly scarce and costly, yet bringing in new sources of financing is also difficult. Let me also just give you a perspective from some work that some colleagues have been doing, which is looking at how investment in private infrastructure correlates very closely with country risk. This is some work hopefully that will come out in the next month or two. What you see there are 4 graphs. The top left-hand one is a correlation between FDI, that's not infrastructure specific. FDI is a percentage of GDP, and country risk, which uses the Euro money ratings. And we can see there is a correlation, but it's not all that tight. On the other hand, if we look at private participation in infrastructure, and this is investment volumes taken from that same database that we just looked at, and correlate that to country risk, we see a much tighter fit. And if you look at, say, a sector like energy, if you look at the bottom left quadrant, it's tighter still, and would be even more so for water and also probably for transport, which is basically saying that although some countries still have good risk ratings, investment grade, if they're not, or if with more challenging global financing conditions this worsens, we can expect perhaps more difficult conditions, ceteris paribus, for attracting private sector investment. Probably an exception, and we're not really going to talk about this, is in telecommunications, unsurprisingly, where people are quite comfortable about taking market risk. So we're just going to, let's step back now and look at what governments can do about this. And essentially, it's all about trying to use the government balance sheet and government resources in an efficient way to leverage more private investment. This could use both direct and indirect fiscal support. You'll see in this diagram, which is taken from a report which we did recently in collaboration with the government of Spain and the Latin America region of the World Bank, a typology. So, for example, if we're looking at direct fiscal support, we have things like upfront subsidy funds, viability gap funds as they're known, and we will go into that. Availability payments and shadow tolls. We won't really be covering that so much today, although happy to take questions on that. And also guarantees we'll be covering as well if you look at the indirect fiscal support. So we're going to be looking at both guarantee funds and new financial instruments, which very much have involved increased risk bearing by governments to bring in new players into financing PPP projects. So that's the sort of coverage that we're going to be looking at today. Just one thing to emphasize, which is that this fiscal support is obviously essential to get PPPs done. Obviously, it's not sufficient in its own right. Many countries that are trying to do PPPs probably don't have the right overall enabling framework in place. That could vary from not having strong enough political will to not having incentives for line agencies to pilot PPPs, to not having the right legislative framework in place that perhaps takes care of both investor concerns and also facilitates the development and approval of PPPs. So none of these in itself are going to matter, and as we'll see from some of the examples we look at, the performance of these mechanisms that have been put in place very much depends as well upon the overall enabling environment. So let's take a look now at some of this. Just by way of background, if you'd like a bit more information on some of the things we're talking about, there are a set of 3 reports. I referred to this earlier. It was work we did possible with the generous support of the government of Spain and in collaboration with the Latin America region of the World Bank. You can access these, I believe, from the E-Institute site. You can also access it from our global PPP network, and I've given the address there. And this has a lot more detail on some of the mechanisms we're talking about. Let's, though, sort of talk now about, first of all, the subsidy approaches. We'll spend some time going through that. And clearly there has to be good policy rationale if governments are going to provide support in this way, grant-based support to PPPs. And the obvious one is that you have projects which are economically viable but financially unviable. And there's 2 main reasons why projects may not be financially viable. It could be that it's simply politically difficult to set user charges to cover capital costs. It could be because it's supplying low-income consumers. It could be there's some genuine political sensitivity. There could be some other reasons. Or it could be that the projects themselves have public good aspects, which means it's difficult to capture from general user fees. That's the sort of predominant rationale for looking at this type of thing. Why might this be more of an issue now than it was, say, 4 or 5 years ago? Well, if we look at certainly many of the major markets for PPPs a few years ago, commercial bank financing for the debt for the projects was really quite cheap, extremely low margins over risk-free rates, and what we are seeing is increased capital costs, increased pressure on costs more generally, and so probably more of a requirement to think about how to efficiently use subsidy schemes to support PPPs. Now, there's a few different approaches to this, and again, looking at the typology of these, we see a couple of types. I mean, we have some schemes which are explicitly there to support public-private partnerships, and we'll look at a couple of those. One is India's fund. It's popularly known as the Viability Gap Fund. We also have the fund operated by Fonedin in Mexico, Fondo Nacional de Infraestructura. So those are a couple of examples of schemes where actually money is set aside in different manners to support PPPs, and there's particular mechanisms for doing this. Of course, providing grant-based support to enable PPPs to go ahead isn't that new, and many countries do this without having a fund in place. And what they do is have a mechanism for allocating subsidies, for making decisions on this, criteria for how much subsidy to give, what types of projects are eligible, and then mechanisms for allocating this within the budget, and including monitoring the long-term fiscal cost of these if it involves payments over the life of the project, which is more complicated to keep track of than the upfront grants that we see, for example, from the Viability Gap Fund. Some of the key things to look at if you're thinking about these subsidy funds are things such as how are funds appropriated in the budget, what are some of the mechanisms that are in place to actually decide on who can ask for subsidies, which projects can ask, who approves it. There's obviously a set of things that have to be done to think about which projects are eligible, how much subsidy to be given, are the limits, how is the subsidy determined, the actual detailed mechanics of how subsidies are paid, and all of the related policies supporting this. All of those things are things which are in place to try to ensure that subsidies are used as efficiently as possible, that each dollar or whatever unit of currency of subsidy is given leverages the maximum benefit, economic benefit. And there are different ways in which this has been set up, and these reflect different approaches. And let's look at a couple of those now. We'll start with India's scheme for support to PPPs and infrastructure, which is the correct title for what's known as a Viability Gap Fund. It's really explicitly there to accelerate and increase PPPs and infrastructure. So this is a situation where money has been set aside for PPPs. There is a cap on the level of support both from this scheme and overall that can be provided by a sponsoring entity. That could be, for example, a state government or another subnational government or a line agency. And that number is capped at, in total, at 40%. There's obviously no magic number there. Why 40? Why not 35 or 45 or 50? And it probably reflects a couple of things. One is that if too much subsidy is required, maybe the project should be done on a very different basis, because this is really aimed at trying to support projects which have a minimum of 51% private equity, mostly on a concession type framework. And if a project can't be supported with that level of grant, perhaps it should be done on a very different structure. The scheme is financed by annual provisions which are made through a regular budgetary process. What happens is that there's a revolving fund maintained as well, which this is paid into. But its funds are not locked away in the sense that it's not a separate dedicated fund. The revolving fund is there to ensure that there's liquidity. There's a set of rules, and you can find this on Government of India websites, for example, to flick through that. But some of the essential things there are that the subsidy itself, the amount of gap, is determined by a competitive bid. So a number of things are fixed, including things like tariff, and there's a presumption or a preference for using standard contracts. Now, obviously, with any of these types of schemes, the question comes up is, how does the government know that it's not giving too much subsidy? And so there's an overall cap to help control that. There's competitive bidding. Still, you could ask the question, projects could be over-engineered, for example, and a line agency or a state government could come forward with something that's gold-plated, and there is, I suppose, there is that possibility. There is an attempt to look at total project costs and also to certify that tariffs couldn't be above where they are. And to some extent, there are perhaps reference points that can be used. For example, what tolls are set for national highways and others. But there is a certain level of flexibility there. The mechanics is that the grant is dispersed following the dispersal of equity and dispersed proportional to debt, and there's very much a reliance on a lead financial institution to take this forward, both to monitor the project, and the presumption there is that the lead financial institution, since it's lending a lot of money, has the same interest as the government there, so there's a convergence of interest. It's important to reiterate, particularly if you look at the performance of what's gone on, that this is only one of many elements of a PPP framework at the national and also state level in India, that there are, of course, different types of policy support there. There's other things in place, including project development funds, mechanisms by which the government is trying to encourage lending for infrastructure, including government-backed financing vehicles, and a lot of work on standard approaches and standard contracts, so it fits in there. If you look at the sector-wise distribution, however, there's quite some interesting results, and this is at the final approval stage. So there's a couple of approval stages. There's an in-principle approval. Again, I'd refer you, if you want sort of details, either the report I showed you earlier, or you can go to Government India websites. So far there's 19 projects, at least as of a few months ago, which had final approval. So the bidding had been finished and financial close has gone on ahead for some of those. And actually, they're very heavily concentrated in the highway sector. If you look at in-principle approval, it's slightly different. There's, I believe, an urban project, which is urban transport in there. So one of the things that this shows is there's quite a concentration of projects in a few sectors, probably driven by a couple of things. One is there are simply a lot of PPPs in highways. There's a well-established model. So you can almost imagine these are being turned out by a machine almost. It's not quite that way, but there's quite a lot of projects there and people know how to do them. Perhaps also the structure of the VGF approaches is really sort of suiting those types of projects. Quite possibly, and perhaps different approaches are going to be needed, things like urban or social infrastructure, which actually has only recently been added to the list of eligible projects, need quite different forms of support, maybe higher levels of government support, maybe government support which should be paid out more during the project, because this type of subsidy approach is, although there is an allowance for payments during project, it's pretty much all so far been upfront, what you might call capital grants. So we see perhaps that this is really suiting particular types of projects. And that is one issue about trying to maintain a cross-sectoral subsidy fund, is that perhaps one size doesn't fit all, and it's difficult to design something which is sufficiently flexible. On the other hand, one can say there's certainly a lot of strengths about this approach. You have a fairly predictable funding source, and obviously a lot of credibility anyway with the government of India behind it. There is market-based determination for the level of the viability gap that's provided, and also the fact that there's a cap given on what the amount of subsidy that's given. I think it's quite a strong filter. In some ways, that cap is saying that yes, there's lots of, in theory and paper, there's lots of projects which have good economic viability. We know in practice that is sometimes hard to establish and depends on the assumptions you make. So the financial viability of projects is being used as a proxy for the economic viability. And that helps filter stuff and simplifies things. It also leads to the outcome we've seen, which is projects are very much concentrated in those sectors where projects are closer to financial viability. I think one other thing to draw from this as well is to some extent this performance-linked dispersal. Bear in mind this is an upfront subsidy. It's not for payments for service delivery. But it's done in line with debt, supervised by lenders, so it has some discipline in it that way. Let's look at another example of a subsidy fund approach, which is Fonodin from Mexico. And this has a set of objectives which are reasonably similar. Again, it's to support private sector investment in infrastructure. Fonodin actually can provide a number of things, and we'll come back to them when we look at guarantee mechanisms. But it also provides financing and guarantees as well as subsidies. And it was part of a bigger effort to increase investment in infrastructure in Mexico, with a big emphasis post the global financial crisis on trying to mobilize new sources of funding. One difference from, for example, what India is doing, at least with its VGF, is that this is a capitalized fund. A set of resources were transferred, including from a collection of toll roads that had been private, were nationalised, and some of them were reconcessioned. So those resources have been used to help capitalise Fonodin. There is, as with the VGF scheme, there is a set of eligibility requirements. So, for example, a minimum of 20% of equity investment overall in the project, and subsidies in the main bid variable. There is a couple of differences in that the subsidy isn't perhaps so performance linked as we see for the VGF. Subsidies are paid according to a payment schedule in a contract. They're not really necessarily paid according to the drawdown of debt. There is, again, if you would like more information on this, I'd refer you to one of the reports I showed earlier, which you can download from the E-Institute site or from our global PPP network. There's obviously a decision-making structure in there, which includes, excuse me, the Ministry of Finance and others, which is to help ensure that there's acceptance that these are priority projects, that the subsidy makes sense. Obviously, it has to try and address many of the same questions that we've seen for the VGF. So here's some information on what's happened so far on terms of the projects. Actually, there's some similarities that we see to what India has seen in a concentration in a few areas, predominantly transport. Possibly, again, because, and quite rationally so, the criteria helping push towards projects which are more commercially viable. So subsidies are perhaps leveraging more private investment, and you could argue that perhaps this is also financial viability, again, as a proxy for economic viability to some extent. What we can see is that there's so far it's approved just over $1 billion in subsidies, and in addition there's a set of other fiscal support being provided from Fonodin. There's a couple of challenges as well that we were noted in trying to evaluate what this fund was doing. There are many projects which come forward which could be viable, could be economically viable, could be good projects, but they're not well prepared. And so the pipeline, particularly for subnational governments, is really not very firm. There's projects that come forward that don't quite have the level of due diligence that's required, and that's something which obviously they're trying to address. Also, because Fonodin can offer a range of instruments, sometimes there's a preference for support via guarantees and subordinated debt. What we do see from this is very much a concentration on things like urban transport, particularly for projects which are under preparation. So again, a focus in a few sectors. Clearly there's been some impact in terms of helping leverage investment. It faces some of the same issues that we saw in India in trying to decide, how well have these subsidies been allocated. And in fact, if we just sort of go back to that and just reflect a bit on the subsidy schemes that we've seen, I think it's fair to say that there's a few issues that one has to think about. First of all, we looked at two schemes where money is actually set aside in different ways. So in India, the money is set aside on an annual basis. Fonodin, it's actually a capitalised fund. I suppose it raises the question from more of a broader public policy question as to why should you set aside resources specially for PPPs in terms of this grant support? Shouldn't PPPs compete through the regular budgetary process as other projects? And in fact, there's probably a lot of merit in that. I think to some extent some of these schemes could be viewed as transitory, that when governments are trying PPPs and trying to scale up PPPs, there are many agencies or government, subnational governments that perhaps aren't familiar with PPPs. It involves new ways of doing things. Maybe you need an incentive. Maybe you need an extra pot of resources that people can tap into to incentivize people to use these projects. Probably they shouldn't persist. And in fact, we've seen a recent example of that. The United Kingdom had this private finance initiative credits, which it has since discontinued. And one of the rationale for that was that PPPs had been mainstreamed, so it didn't need this type of incentive. So that's one important thing to bear in mind. And we do see, for example, some countries just have quite rigorous processes for deciding on subsidies for PPPs, including multi-year subsidies, and Colombia is an example of that, again Brazil, but there's not necessarily extra money set aside for that. The second issue is if you're going to do this, you need something. So the first aspect is from the government standpoint, do you set money aside? The second aspect is from the private sector standpoint, is this thing really going to be attractive? So you have to think about actually the level of a lot of detail. How does the money actually reach projects? If there's a quite torturous process which goes from the Ministry of Finance through a line agency, etc., you could raise some serious concerns there about resources being available when they're needed, construction milestones being missed, etc. So that's also a level of detail one would need to look at. Let's move on in the interest of time, and we'll look at financial guarantees. And we'll look at examples from a couple of countries in Latin America, Brazil and Mexico. Brazil both at the federal and at the state level. Obviously, guarantees are particularly important to bring in capital market financing for PPP projects. Capital markets are fundamentally they're ratings driven. So this is obviously a key way of trying to expand sources of financing. What I'm showing you here is basically a comparison of two schemes at the national level. One is in Brazil, the National Guarantee Fund, which actually, for lack of a pipeline, hasn't done a lot, and the one transaction listed there is being rebid anyway. And also a couple of schemes that are active in Mexico. Again, I'd refer you, if you want more details, both on the overall mechanics of these as well as these specific schemes, to the reports I'd mentioned earlier. But let's just look at a couple of sort of headlines from that. The Federal Guarantee Fund it's a capitalized scheme, although a lot of the money has been taken out of this now, probably rationally so, because of there's not much of a pipeline there, and probably there are other higher priority requirements for this over the last few years. It just guarantees government payments, and this is a guarantee it's not charged for. There's a couple of challenges there. The guarantee is really only made available after the contract's signed, and also, as I'd noted, it's a bit difficult to say a lot about how this has worked in practice, although this mechanism was the inspiration for a number of schemes that have been designed or going forward, just simply because for federal government public-private partnerships, the pipeline's been pretty weak. There haven't been many projects coming forward. The one that did was an irrigation project, in the end had to be rebid. So it's a bit difficult to draw a lot of lessons from that. Perhaps of a bit more interest, and which may also provide some inspiration, particularly for subnational governments, is some of the work that state governments in Brazil have been doing. For example, in Bahia, where we have a number of projects being supported by a scheme which is not a guarantee fund in that sense. It's not as firm as that. It's basically putting resources into a separate bank account, which is there to try to guarantee PPP contracts. When I say it's not as firm as a guarantee fund, I think whereas you see some funds where resources are locked away and they're dedicated for that use, that's probably not the case in some of these mechanisms that state governments have set up. But nonetheless, it provides some credit enhancement. You have special entities and trusts that are there, hold the revenues, supports commitments of states for a couple of payments, one payment under the PPP projects, and at least helps provide some security there. It's obviously easier to set up that type of mechanism than a guarantee fund, and you don't necessarily lock resources away to the same extent. It's probably doesn't provide quite the same level of credit enhancement. If we look at Mexico, a couple of approaches here. One from Banobras, Development Bank, where there's a couple of different types of schemes being offered. One is on timely payment guarantees, and the other is contract payment enhancement guarantees, of which the first, it's really a guarantee on the timely payment of principal and interest. There has been one done so far in a refinancing transaction for the state of Mexico. That's a subnational government, obviously. And for the contract payment enhancement guarantee, there's just been one of those done, basically for a collection of projects, for about 3 or 4 projects, but I probably need to check that, for the state of Mexico. So that was trying to leverage financing across a range of projects and cover government payments under those. FONADIN, which we discussed earlier in the context of looking at subsidies, also has a set of guarantee instruments. And again, you can find out a lot more detail on these from those reports, but essentially there's guarantees on related to last payment, pari passu guarantee. There are some limits imposed on this. What we've seen is that, again, this probably hasn't moved quite as fast as people might have expected. Some of this perhaps is due to people trying to turn to this agency maybe for loans, in case of Banobras, rather than guarantees. It could be partly trying to get familiarity with the instrument. It's also perhaps looking at maybe there's some other risks involved which aren't dealt with, and people need to get past those. So in terms of the actual usage of these, I would say when all of these guarantee schemes, there's probably less we can draw on from compared to the subsidy schemes we looked at earlier, which we would see as having a more of a track record. Clearly, as we sort of look, and in fact, this provides a segue into some instruments that have been developed for PPP financing to crowd in new sources of financing. There's obviously a requirement for governments to think about how to credit enhance their PPP projects and what the most efficient way is of doing that. And so some of the guarantee structures we looked at could represent one way of doing that. But actually here we have a couple of other approaches. Some of those are drawn from Peru, some in Chile. Obviously, quite well known was Chile's approach to using infrastructure bonds, and these were quite commonly used before the financial crisis. And of course, as we all know, monoliners were very active pre-financial crisis as well to help achieve financing through capital markets. Excuse me. We do still see some investment in these and from pension funds and PPPs, very much reliant on minimum revenue guarantees to provide the right level of credit enhancement. There's also been some interesting mechanisms, although they're not without some controversy, that have been developed. In one case, to fund large projects, a couple of large road projects in Peru, certificates for advancement of works, so CRPAOs, as the acronym is in Spanish, to basically crowd in funding from pension funds and institutional investors. And essentially it relies on, as work on the project progresses and certain amounts of investment are done, that's then certified, that gets translated into a financial instrument which enables financing the project to proceed. There's, from the investor's perspective, since the certificates are unconditional, it's an unconditional, irrevocable obligation of the government of Peru. They're good investments. There was five projects done, of which I think at least one was about $1 billion project. So it was very much used for these large projects. More recently, there's been a similar approach, which is perhaps an evolution of this approach used for smaller projects in hospitals, for example, where a similar type of structure is supported in a trust, and these have been used for a couple of recent hospital projects. Again, there's a lot of detail on this in the reports I've mentioned earlier, which actually describe the precise mechanics of how that works. I think probably we are close to or at the time for the webinar, since I think we'll also allow time for questions. Let me just reflect on one other thing, which is really about, since all of this involves governments trying to use their balance sheets to crowd in financing, to bring in new investors to leverage investment using grant resources. So it puts a huge amount of emphasis on trying to understand value for money. Clearly at the limit, if governments are prepared to guarantee all sorts of things, they can get whatever financing they want, but that's not going to be ultimately necessarily a good deal for them. So there has to be renewed attention both on improving capacities for doing this and also structures, decision-making processes that bring in the right range of people, attention from Ministry of Finance early on to understand the cost and value for money, whether, if you need a certain level of support and credit enhancement, maybe actually it makes sense to do it as a public project, not private. And a lot more emphasis on trying to understand the financial and fiscal costs to the government, both now and over the long term of these projects. So that's really an increased emphasis there for governments to strengthen what they're already doing, both throughout the process, both in project appraisal, decision making on whether to proceed with the project, and also obviously contract management to ensure that projects are kept under control as they proceed.